Good morning, everybody. Sorry for this mishap in this first session. Marcos was, for a strange reason, on mute. We would like to start now with the presentation, and we jump immediately to actually the first slide that you were actually talking about. Thanks a lot, Marcos. Sorry for that.
Okay, sorry, I apologize. So let's restart a little bit with the, where are we situation? So to sum up, we have been in a decade which has been unique, somewhat, very low rates and massive liquidity. In this scenario, all the valuations were up, all the boats were lifted. The Standard & Poor's, an average per year of 13% for 10 years, Nasdaq 17% per year, which is doubling every three to 4 years, and very positive scenario for growth, for tech. So we also saw some strange animals, as I was trying to explain, cryptos, SPACs, meme stocks. So this is quite normal in a scenario where liquidity is almost for free, and also very high valuations, bonds, real estate, and some other asset classes were clearly overvalued. So, following this global financial crisis in 2008-09, we have had 10 years of, free money party. Now it's time to go back to normal in slide 4. So here I wanted to highlight the outperformance of growth versus value. In slide, 4, Alex, if you can, in the previous one. You can see the big outperformance of growth versus value in the past decade, which is not normal. And now it's time for a more, normalization of the economics. We will have higher inflation, higher rates, probably higher commodity prices and energy prices. Also, we think that we're going to see a new CapEx cycle with heavy CapEx spending from industries and infrastructure, which is clear. The energy transition has to happen, and this will lead to a lot of CapEx also in different parts of the economy. And, we will be back to valuations, cash flows, fundamentals, and value, which is, the normal world. The next slide, I want to touch a little bit about the macro conditions on inflation. I will go fast. We think inflation will normalize in the next 2 years. It will normalize possibly to higher levels due to labor scarcity and also energy scarcity. But, prices of goods have normalized, services prices are normalizing, and labor will normalize in the next 2 years. So 24 will probably a year of, 2-3% inflation and much more normal conditions. So more or less business as usual. On the next slide, a word on China, which was a surprise for us. So they changed completely the policy from zero COVID to let's grow again. So you can see here the expectation for China this year have moved up substantially to a GDP growth of 5 to 6%. So there are still risks, basically property and consumer, but the economy looks like has started a rebound, and we think this will happen and will be positive for the global GDP growth. However, in the next slide, you can see the PMIs. So here is a kind of indication of where we are on a short-term basis in the cycle. So these PMIs peaked by the end of 2021, and normally they take 2 years to go from peak to trough. It's the same when they cross 50, the 50 indication, which takes you to a kind of a slowdown territory. And now there's normally from the 50 to the lows, which are usually below 40, it takes 1 year. So we think that 2023 is going to be tough from a macro perspective with an economic slowdown. Nobody knows if this will go to a recession or not, because the model is too dynamic, but we need to be patient, let's put it this way. So in summary, we follow 4 leading indicators in this cycle: PMIs, downgrades, liquidity, and China, and only China has turned positive. So this is leading us to be conservative when we are managing the funds. The new cycle will probably start in 2024. But anyway, the message is clear. We do not really care that much. So all our investments are high quality. We don't have debt, good management, etc. So we think that if the market goes up, we'll do fine. Markets go down, we will buy a lot on a cheaper situation. And the new cycle, as I wanted to say, will have a lot of new themes that we will try to play: energy transition, the new organization of the supply chains, capex in infrastructures, capex in non-residential, labor, energy, and commodities. So there's a lot of things that we want to play, and we will comment on that in the next slides. Just a word on valuation in slide 9. If you take, a top-down view on where are we in valuation, Alex, if you can pass to the slide 9, you can see that, we are in the middle of the PE on a worldwide basis. So, we don't find the stock market expensive. It is not cheap either. And, as expensive sectors, we find industrial, technology, and growth, if we can call growth a sector. Cheap sectors would be banks, energy and materials, and value. And the other 3 big sectors are more or less listed or trading at normal valuations: consumer, healthcare, and insurance. In the next slide, you can see that probably the most important market worldwide, if you want to see where we are in valuation, which is the Standard & Poor's 500, it is trading between 17 and 18 times earnings, which is very much in line with historicals. Europe is very cheap, 13, 14 times. Emerging markets are really cheap, although we have a lot of, geopolitical issues. And the only geographical index we find is expensive still is the Nasdaq. So now I'm going to hand over to Carlos, who's going to deep inside the energy space.
Okay, well, thank you, Marcos. Yeah, as we've said many times, I mean, we don't spend too much time arguing whether inflation is, going down, peaking, not peaking, for the very simple reason that we do not know, and nobody knows. I mean, it's a very, very complex subject, extremely complex. But one thing is clear. I mean, prices go up either because demand goes up or supply goes down, or both. Now, during the COVID crisis we had, and just in the aftermath, we had lots of supply chains disrupted, so supply going down. At the same time, governments made an effort to sustain the economy with payments, direct transfers in some cases to people to compensate a little bit for the hardships. So we had less supply, more demand. Well, you should not be surprised to see prices going up. Well, now that is little by little normalizing. Supply chains are normalizing. It takes time, but I mean, people go to work every day, and most of them do something. So this is normalizing, and of course, the very, very accommodative stance from the authorities, both monetary and fiscal, has been removed. So now what we have is more supply and less demand. So we should have obviously much less inflation. However, there is an issue, and we can see it on the next slide. So we should see prices coming down. We are seeing prices coming down, but we have to always, I mean, inflation is not like the spring that, will come sooner or later. Inflation, as we said before, it is due to something. Now, there is a input to the economy that, as we have discussed many times, is the most important input, which is energy. And we have all the reasons to believe that energy prices are going to go up. Now, again, why? For the same reason. Is supply going down? Is demand going up? And the answer to both is yes. On the chart here on the left, you have the inventories of crude oil. You can see how they went up during the lockdowns because nobody was using oil. So many people kept producing, so the inventory goes up. Eventually that stopped, and then it's been going down, 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 down. I mean, they are not down to zero. They will never be down to zero for obvious reasons, but they're getting very close. Now you could say at the end of the day that is not that important because people do not use oil. We do not use oil. We use gasoline or diesel or jet fuel. So what matters is not whether there is oil or not, but whether there is gasoline. Now, obviously, if you now, I could not put the charts here, but the inventories for what they call mid-distillates, which is basically diesel for trucks, for commercial transportation, and jet fuel for planes, it's about 1.5 to 2 standard deviations lower than normal. So we're running out little by little. This is a very famous Hemingway phrase that we use sometimes. How did you go bankrupt? Two ways: first little by little, and then first gradually, and then suddenly. Inventories go down, and as they go down, nothing happens. But as they get to zero, then a lot happens, as we saw in October, November last year. So we are getting there now. If we don't have gasoline, well, the solution is very simple. You tell the refineries to make more gasoline, but then there's where we go to the other problem. Now there is no oil to make the gasoline, and there's no spare capacity. We don't talk too much about refineries because it's kind of a different industry. But everything that we say, almost in every call, about people not investing in oil production and running down what we have, well, that's even more so in the case of refineries. Europe has not only not built any refinery, it has closed many refineries because nobody wants to have a refinery. And since now some people decided some time ago that we are going to run on, ODV or cars, but we don't need the refineries. So they've been closing down, so there are no refineries. So there is no chance now to rebuild the stocks of diesel and jet fuel. Now, that doesn't mean that trucks and planes will stop flying tomorrow, but it does mean that it is going to get more and more expensive. Of course, if you don't have too much oil, what you have to do is go to the ground and get it out. But then this is the second chart here. This is the amount of new projects that have been approved every year for the past few years. And to summarize these numbers, it's very simple. For the last few years, not so few, or almost 10, we have been approving enough new projects to extract about a third of the oil that we are consuming. And you don't have to be very, very fast at math to realize that those two curves are going to meet pretty soon. If you keep resupplying your stock with a third of what you're taking out of it, because the biggest stock for oil, of course, is not in Cushing, Oklahoma, it's inside planet Earth. But of course, it's only stock of oil if it is a developed oil field. Otherwise, it's a theoretical, very long-term stock of oil. So the only oil that we can actually extract from the ground tomorrow is the one that, it's done. It's in fields which are developed with pipelines and everything. Well, that thing, we are replenishing it at a third of the rate we are using. So that means that very, very fast, we're going to run out of both the oil in the stocks, the jet fuel, the diesel, the products that we use, then the oil that we use to do the products, and then the oil in the ground that we use to supply the refineries with. So what has been happening now? The next slide that we've showed sometimes. This is mankind, particularly European kind, if we can use that word, has been putting all the money that normally had been spent. And when I say all, I mean all that had been spent on maintaining those energy inventories. It's been put on renewable energy. Now, renewable energy has all kinds of wonderful things about it. We're not going to get into that discussion, but it has a bad thing about it, is that it is useless. It is not enough to power modern economies because it is intermittent. Now, some people say, yes, well, we'll make batteries. Okay, fine, maybe. And that day, what I'm saying now will not be true. But that day is not there. And it's not going to be there tomorrow, the next year, or in the next 5 years. Now, there you have the demand for energy in Germany, for instance, and the supply of renewable energy for Germany. So the reality is that in most days, or in many days, in fact, it's enough that it would be in a few days, renewables do not produce the energy that the modern economy needs constantly. You cannot stop a modern economy. You cannot switch off the lights in a modern economy for a week, not even for a day. Now, and the next slide is very interesting, and this is, I'll wrap up with this because this gives you a very clear indication of what is going to happen. This is a very interesting website, by the way, you can access in real time. that it tells you it is done in real time, every day it changes, the mix of energy production for each European, actually for each world country. I just took the thing of Europe. Since of course CO2 is supposed to be bad, the more CO2 the country emits, the darker the shape is. And then you can see that Poland is black because Poland uses a lot of coal, which generates a lot of CO2. But then the next country pretty much is Germany. Now, Germany, which is the greenest country in Europe with the Green Party formally in government, they're so green that they have decided to shut down the nuclear plants, is the country in Europe that is using most coal after Poland. And on the chart on the left, you see this little bar, these little bars. The gray bar means the amount of installed capacity. So you see that if, this is in French, éolien, if wind and solar were working full blast, Germany would not need any other energy, which is exactly what green people say, which is true. I mean, that is mathematically true. The problem is in Germany, there is no sun at night, and there is, like in most other places, by the way, and there is no wind most of the time. So you can add as many windmills as you want. You can make that gray bar as long as you want, that the blue one for wind will be whatever the wind is that day. By the way, this is not just the pick and choose. This is from last week. I took the chart on the 6th of February, 10 o'clock in the morning. You can check this every day. Now, when the wind blows very hard, then it's beautiful. Then Germany is as green as everybody. But of course, you cannot run an industrial economy just a few days chosen randomly by the weather. So all this is going to say that we're going to see a lot of investment in energy. This is to show, by the way, that politicians, newspapers, they can say whatever they want. Every other page you read today in the New York Times, in the Frankfurter Allgemeine Zeitung, in the Süddeutsche Zeitung, they all tell about all the transition, all the things we're going to do, how everything is going to change. And the reality is that Germany is opening coal mines. And I said Germany, China is, of course. I'm saying Germany. Because, and everybody, and this is just the tip of the iceberg, because all the LNG, all the liquefied natural gas that Europe bought in November, when we panicked because Russia was cutting the supply, we bought it, we got it. So we didn't freeze this winter. Pakistan did. They couldn't buy any LNG at the price that Europeans are ready to pay. So Pakistan has formally dropped LNG from their energy policy and decided that everything is going to be done with coal. Now, you may not think that Pakistan is a very important country, but it's two and a half times as big as Germany in terms of people. So this is where we are. So we might find something that nobody is considering. We might find a bit more inflation than expected next year because of energy. And we may find that many of the investments that have been made and not been made in energy are going to be very, very interesting investment opportunities. That was my point. Thank you.
Okay, thanks, Carlos. I'm going to take over and start the update on the funds and some investment cases. So I'm going to start with the classic. So we can go to slide 17. The classic fund did well last year, up 14%, higher than our target of 10% and well above of most indices. Best sectors: defense, cables, power cables, aerospace, oil, and some consumer names like Devro, where we had a takeover, and cleaning and catering. And the worst sectors were salmon due to the new resource tax imposed by the government, health with Grifols that we comment later, and technology with the SML within the whole technology correction. So it was a good 22. I wanted to highlight a couple of themes because here some investors do not find the classic interesting enough because we don't have a theme or an idea or a narrative that is mega attractive aside from value. But, you know, I wanted to highlight here a couple of things. First of all, the main factor of the classic, which is value, beats growth and global indices on a long-term basis. So this is per se very interesting. And second, the layer of strategic analysis we add, it's also adding not one narrative, but several narratives. So the classic incorporates several interesting trends like salmon, the short of supply, aerospace, which will see very good growth, defense, following the Ukraine invasion, power cables ahead of the energy transition, electrification, etc., etc. So it's not only one thing that we want to highlight here. It is, you know, value and then strategic analysis, and we call it strategic value, as you all know. In the next slide, you can see the slide that I normally add in all the presentations in order to take a quick look to half of the book. So here you can see 50% of the classic. All the names are what we call the 4Gs. So good business, good management, good balance sheet, and good price. Energy remains our only concentration factor. We have more or less 15% now in oil and gas, and it is very well diversified. As usual, in these 10 names, you can see that we have more than 10 sectors. So concentration and diversification in the same fund. In the next slide, I wanted to update you on the IRR and intrinsic value. So we updated the numbers for the classic in December. As we have commented, we are in a slowdown, economic slowdown, so we are managing the fund on a conservative way. And also we had a takeover on Devero, which is, you know, having a dilutive effect on IRR and IV. The intrinsic value is now 865. Last price is around 590 euros per share, and the expected return on the fund is 14%. So we set a target for 2023 of 625 euros, which is basically calculated applying normal valuations to all our names. But the most important thing is that we already see 1,000 euros per share in 5 years' time, in 2028. So it's very important to keep here the long-term view and the compounding effect of the returns. So, you know, if we take out the fees and we make both successes and mistakes, we should be able to double the investment in 6 to 7 years. As a reminder, we are very invested, the team is very invested in the fund. I'm going to go fast to 3 of the investment cases we hold. It's important because we more or less have 15% of the classic in 3 names: Pandora, Grifols, and Harbour Energy. I'm going to start with Pandora in slide 22. So why Pandora is cheap, why the stock is down? Basically 2 factors in our view. One is earnings risk because people are fearing the recession. And the second is the restructuring outcome, which is still not finalized. But in our view, Pandora is a great business. They have, you know, scale advantages, cost advantages. Restructuring is progressing well. You know, the slowdown or the recession may have a, you know, a structural kind of short-term impact, but not a structural. We don't think it's going to affect them in the long term. And management team, both management team and balance sheet, is excellent. So we have a price target which is doubling the current price and an internal return expected of 20%. The next case I wanted to highlight is Harbour. We've known Harbour Energy for more than a decade. It's the resulting company merging from Premier Oil and Chrysaor. There's many reasons not to buy this name. It's a small E&P in the North Sea. They had higher and increased taxes. Reserves are not very large, 7-8 years, although this depends on prices, obviously. And, you know, they are exposed to the cycle. So this means that it's a high-risk stock. However, the assets are good assets. It is true that they are small and they are tier 3, but they've been operating very well for many years. Management is good and they don't have debt. So just as an indication of the cheapness of the stock, free cash flow last year was $2 billion and the market cap is 3, and they don't have debt. So basically, you know, 65% of free cash flow yield, the company could buy itself in 1.5 years. So we have here also more than doubling. Our intrinsic value is 750 pence, and the stock is moving around 300, so more than doubling in the next few years. And the final investment case I wanted to highlight is Grifols. You know the name. We have been there also investing for a long time, and we are convinced that the strategic shift is moving in the right direction. The management has changed, although there are some few changes lately because the new executive chairman is dismissing because of health problems and is being replaced by a new guy. But we think that the strategic shift is moving in the right direction. We are assuming a gradual improvement of the business in the next few years after the COVID-19 and some mistakes like, too many acquisitions and high debt levels. So we think that the company will be back to normal in 3 to 4 years. And, our price target is 23 euros and the stock is trading around 8 to 9. Price earnings 11 on depressed earnings and IRR more than 20%. So important, to highlight here that in 3 names, in 5 minutes, we have gone across 15% of the classic fund, highlighting the deep value we have in the fund and the quality of the fund, because these companies, all of them are high quality. We can debate a little bit for Harvard, but it's an oil company and it has been managed very well in the past few years. After that, I'm going to go to the natural resources, a little bit wrapping up what happened last year. So in page 26, so the fund is doing fine. The commodity super cycle, we are convinced that the super cycle has started. In energy, the problem is underinvestment since 2014, that is leading to undersupplied market. Nobody really wants to invest in oil, basically to the ESG constraints and also fear of peak demand. A lot of people think that the demand for oil will start fading in the next few years, and this is not going to happen on our numbers. On metals, the equation is easier because we have underinvestment combined with a massive need of metals, what we call green metals, nickel, copper, cobalt, etc. So here you have the 2 sides of the equation that are heavily unbalanced. The fund is progressing very well, 40% in 2021, 13% last year. If we adjust by Russia, we had, as you remember, 3 names in Russia that are still trading, but we are mark to market them at 0. We were up 17% last year. So 60% in 2 years. Some people ask us again if this is over, and we are convinced that this is only the beginning. This is going to be a very long cycle and probably for decades. In the next slide, you can see a little bit the breakdown per commodities. Just remind you that we only invest in companies, but this is the look through. We cut a little bit on oil and gas. Now oil is 1/3, gas is more or less 5%. We increased in copper, which is now 24%. Uranium remains the same. And the main other things that we're invested in is salmon farming, that I will touch now, and cement. So this is basically the breakdown. And just very briefly, how we try to add value. Scarce commodities, safer geographies, near production, no startups, too much risk, and no majors because they are divesting in commodities and investing in renewables, which is not the right trade in our view. So in terms of updated numbers, the IRR now it's 14%, very similar to the classic. Intrinsic value 208, last price 150, so still plenty of upside to mid-cycle. And I wanted to highlight here a problem we have in, to transmit the upside in this fund, because all the numbers and the intrinsic values and the IRRs are mid-cycle numbers. And I wanted to highlight here an example. If I try to value Cenovus, the oil sands company, I start with a free cash flow yield, which is more or less 20 to 25% of the market cap at current oil prices. So this means in 4 to 5 years, I will have recovered the full investment and then have the company for free. So what I mean by this is that the valuation at mid-cycle, which takes the up and down of the cycle and normalizes, is very conservative, because what happens how much is worth Cenovus if prices remain at $80 more than 5 years, maybe 10 or 15, and what happens if oil goes to 150. So this can be applied to the whole fund, which is being valued at mid-cycle, but we are convinced that we're going to see very high prices of commodities and very high margins and returns for decades to come. So I don't think there's a need to put a number on that. But what we say is that we should be doubling in the next 3, 4, 5 years, relatively easy when the super cycle becomes more evident. Couple of words on oil. Basically, the market, as Carlos was saying, remains undersupplied. Spare capacity, 3 million barrels. So we need to really raise CapEx here, but CapEx is not reacting to higher prices. Basically, 4 problems we have in order to reactivate investment. There's a fear of peak demand, and these are long-term projects. We have the ESG barriers, so CO2 emissions need to be taken into account, and they're very costly. They would be very costly. Then we have increasing taxes all over the world and financial discipline, because the companies, at least in the US and probably globally, have applied a higher discipline in terms of reinvestment. Just a quick word here. Looking at the FIDs in the past 2 years that are very depressed, we are talking about 20 projects, 25 projects in oil, when the normal run rate should be 50 or more. These projects have been approved at an IRR of 28%, which is much higher than the IRR that the sector was working on. This means that if we take the similar numbers and we look for the oil price needed, we would need price between $125 and $150 at equivalent numbers in order to incentivize the supply. So this is the scenario we see, higher prices for longer in order to incentivize CapEx here and to beat all these constraints, peak demand, ESG, taxes, and financial discipline. Moving to copper, the story is pretty similar. Just I wanted to highlight a couple of numbers. Supply of mined copper 22 was 23 million tons. And according to Freeport-McMoRan, demand in 2050 will be 50 million tons. So, it's going to be very difficult to get there, extremely difficult. Actually, we think we will not get there, and several risks here. So we have country risk. For instance, Cobre Panamá, one of the biggest mines coming, is now stopped because of the Panamanian government trying to renegotiate the contract. We have obviously ESG constraints that are good, but they are, blocking a lot of projects, and then increased taxes again in most countries. So in the end, we need much higher incentive prices at longer, because these projects take almost a decade to not come into stream. Final word on salmon. We are raising our exposure to salmon. As you know very well, we had a new resource tax in Norway, basically increasing the tax rate from 25 to 65%. So this was very bad news. The sector went down 35%. We did our numbers, and there's 2 new news here. One is that the government apparently wants to negotiate the taxes. We will have the final decision in the next few weeks. So we'll see if the government proposes a better or more balanced resource tax. And the second thing is that we did a quick calculation. If taxes are higher, investment will be lower, supply will be lower, and prices will be higher. So we only will need 15 to 20% higher prices to keep the historical returns. So in basis of these 2 things, better outcome for the resource tax and pricing on scarce supply, we think that the sector remains very interesting, and we are buying there now. It's more than 10% of the natural resources. So as a conclusion, very fast, natural resources doing fine, 60% increase in 2 years. Nothing has changed on the broad picture. The energy transition is developing as expected. Russia is adding some more pressure to the equation, because, as you know, they are producing 15% of the gas, 10% of the oil, and double-digit of most metals worldwide. So we remain convinced on the super cycle. Valuation-wise, we are still below mid-cycle, as I was trying to prove with my comments on the natural resources. So with that, I hand over to Urs. Thanks a lot.
Thanks, Marcos. I thought I will have a few words what we do in our funds, in the Natural Resources Fund, and why we do this. And a bit to simplify, as we are getting older, and I'm still fortunately the youngest in the team, but at least we have all experienced the upcycle from 2000 in the natural resources, and then the down cycle as well, personally full. So with a lot of joy at the beginning and a lot of tears. And the idea is a bit to do what should have been done in the last bull market and to avoid at least some of the biggest mistake we made. And as Marcus said, the general idea of this fund is that it should be a basic investment in the natural resources industry for somebody who wants to be exposed. And now, if you would look at the natural resources industry from a size, then you would have probably an exposure around 90% to energy, around 4% to coal, 3% iron ore, and the remaining 2% various metals, particularly copper, because the rest is virtually inexistent from a size. So obviously this might be good or not, but our idea is that maybe it should be a good thing to have a general exposure as a basic investment of a third, meaning a third energy, a third mining, and a third agriculture, infrastructure related things. And this is our basic position of the fund. And obviously we, as Marcus explained, we value companies and sectors in mid-cycle earnings or marginal production costs, and some sectors get more expensive or less. And what is happening within sectors, and an actual example is, for example, coal. If something gets too far away from marginal costs, maybe 200 times, then you get some marginal production coming in because it's somewhere possible to mine more coal, which is happening now, even in Germany, or at least in other places. And then, you know, there is a correction, and it can be very harsh, and it's been seen in iron ore, it's now happening in coal. And then you have the inventory effects, what I do call the toilet paper effect. When people are afraid it's getting scarce, they hoard, and obviously when it turns, they dishoard, which can be very volatile because it stops consumption for a few months completely because you run down inventories. So this is a bit to explain what our fund should do. The second thing is what we found out now, Alex, just back, that, you know, you have a mine cycle, and I come to that later. You have a very, very long lead time until you get into production. And these charts we always showing, by the way, I come back afterwards, is only really the financial investment decision. So this is really the time when you decide you build the mine. But, you know, you probably had 40 years already spent in terms of exploring and developing the reserves and the ore body, etc. And then you have the problems of building mines, you know, obviously huge costs, you know, delays and ESG and whatever. And then when you finally get into the harvest season, when the capex is going down and you start producing cash flows. And this is what we found out in a risk-reward way, the best place to be positioned in this sector. So that's a bit the philosophical explanation what we try to do. And by the way, this phase is quite small because soon you might run down the reserves overground, you have to go underground, or you have to develop further pits which are far away. So this can already start again after a few years. And maybe on the next slide, Alex. So this shows a bit this in another example. And you know, the copper reserves we are producing have been discovered in 1927. I mean, it's quite a long time ago. The oil production is very old. Saudi Arabia has been discovered in the 30s and being into production in the 50s. So meaning, you know, we have a lot of time or cycle in this production, which needs a lot of time and is very old. And if, for example, I could provide you charts, we talk about the underinvestments in developing fields or mines. But if you would have charts, and I have some, you know, how is the underinvestment in the exploration side going down, and the development of reserves? This is disastrous, and this is something which goes on for 50 years. And obviously the thing is, you know, you have to have projects to being able to want to bring them into production. So, but that's something which we will see later on. Maybe on the next slide, Alex, just quickly, obviously we have to replace 3-4%. We know this, this is quite big, you know, we need a new Saudi Arabia every third year, maybe nearly a new Escondida every year. without demand growth, just to keep up production. We talked about this many times. And on the next slide, Alex, the same chart, the chart about the structural problem we have in our industry. It's called the big pick the low-hanging fruits first. It gets more expensive. You have to go to worse places, less infrastructure. And we see this in copper grades we mined. It's going down and down and down. It's a structural thing. The future of conventional oil is in the Arctic, which is unfortunately for us 2/3 in Russia and 1/3 in the north of the US, maybe Greenland, but it's not very nice to operate that, or it's very deep water Brazil, or then it's unconventional, which has a different structure. So meaning we should have constantly higher assumptions of prices and investments just to keep things up without any projection of every Chinese buys more wash machines or Indians or whatever. So maybe the next slide, Alex, same as Marcus showed. I want to have a word on this. What is also existing in the mining industry or in our industry in every cycle, you know, we have a lot of people who say, you know, the exploring companies and the projects are very cheap and they are undervalued. And believe me, I invested in them as well. But the fact is, in the last cycle, it was not worth it. First of all, 1 out of 500 ore bodies is coming into production at all. And these are ore bodies, not just a few inferred resources. But what's also happening, and I always say the anecdote of the BHP CEO in the last cycle in a meeting complaining about rising steel prices. Said, you know, you're the biggest exporter of iron ore and coke and coal. Or Alex, which is laughing, he knows what's coming. You know, when we were in Germany on one of our trips, I mean, he was very happy about the oil price going up. And then he had to fill up his Volvo. And I think it was the first time he paid more than 200 euros. And I said, Alex, you can't have both sides of the equation. So there's no commodity bull market without rising costs. We all have to be very happy about cost inflation, because what it means, as Marcus said, it rises, you know, the marginal project costs. And what happens is the replacement value of the existing assets are going up because they're already installed. You know, the mines who are built, or the Caterpillar fleets or Komatsu fleets which have been bought, it gets more expensive for the project on paper. Obviously, the guy who wants to finance the project on paper, he never tells you about that, because on paper, it's always easy as everything in life. You know, like winning the ski races in front of the television is more easy than if you are in Kitzbühel at the start, no? And this is a reason why we don't believe that you have to be in these early exploration projects, but in the built existing assets which produce cash flow, and obviously, hopefully more with rising prices. On the next slide, Alex. This is something, an example is also, you know, the stories about, you know, copper and uranium and, you know, we need this and so this is fine and all well, but at the end, you have to make money. And this is just a story for financing, but to make money is you have to dig something out of the ground with a profitability. Otherwise, it's just a story. And we have not to forget that in the resources industry, a lot of good assets are very, very concentrated, particularly the more expensive, let's say, commodities. But even if the bulk commodities like iron ore, which is virtually useless dirt, but the problem is, you know, it's the same like cement. The useless dirt needs to go to China, and Australia has a structural advantage because of its transportation costs. So the steel industry of China, that's why 50% of iron ore trade is coming from 3 companies out of the Pilbaras, and the rest is virtually coming from Vale, which is going to supply virtually all the rest. And so the good assets are concentrated. And here's an example from the Cigar Lake mine from Cameco. I mean, you see the grades, the average uranium grade is 0.07% to 0.03, whatever. Of course, we have to say that the in-situ production in Kazakhstan, for example, is completely different, very, very small grades. But, you know, Cameco mines 15% grade at Cigar Lake. This is 150 kilos per ton. You know, this is, of course, it's underground. And this example was a disaster to build because it's, as the name says, it's below a lake, which is not so, maybe not so nice if the lake still pours into your mine. But, you know, it shows a bit that even such mines are not productive or not profitable really with such low uranium prices. It is not just having a good story about the demand, but you really have to have good assets. And the good assets are mine life, grade, infrastructure, cost. Yeah, cost obviously is an effect of everything. And so this is also something we want to concentrate on, that really, and tell the people, you know, you have to have the good assets. This lithium story, for example, you know, Australia provides 50% of lithium out of the whole production and 70% of it out of one mine, which is Greenbushes, which is Albemarle, and some minority like independence groups. So for us, if we wanted to would have lithium exposure, it's too expensive at the moment, and we had this, it's just really one company who is, you know, qualifying for our investment style. And maybe the next slide, Alex. So this shows a bit into this reserve resources discussion, but maybe it's a simple thing, but it shows a bit, you know, that there are different steps of resources. You know, it's virtually saying how much it has been developed by geology. Obviously, the more drill holes you do, the more certain it comes. And, you know, then there are funny things. It's a bit like the auditing of, you know, this crooks in the financial industry. What was it called, Alex? The guy in the US. I mean, you have some strange audit company, which is the brother of your sister, and is next to you in Bronx. Maybe it's a bit strange. Yeah, Madoff. So it's similar here, you know, geological samples and so. I mean, you have to be careful who does these things, etc. But the important thing is maybe on the next slide, Alex, to show this, you know, is the conversion into reserves. And this conversion is done by really the analysis if it's mineable with a profit. Of course, this still has a lot of uncertainties, which is obviously the commodity price, obviously the costs, which is hundreds of things, and tax. But, you know, it shows a bit how difficult it is, even if you have something in the ground, really come to the point that it will be mineable ever. So because most of it will never be mined, because constantly costs go up. And if you have bad grades or small mine lives, you know, the cost inflation, which is obviously here because this industry consumes steel and energy, it's the most or one of the most energy intense economies, is going up always as fast as the commodity price for bad assets. And on the next slide, Alex, maybe a little example, you can read that. I mean, this is Escondida, which is I think 4% of the copper supply, with a little bit more than 1 million tons. And this is a relatively new mine, but you know, the story of this mine is it has been developed, discovered, whatever is exactly discovered, in the 70s by Getty Oil. Now the older ones might still remember John Paul Getty. He was the richest person. I think Texaco was sold to Chevron, Getty to Texaco, and then this is now Chevron. And then it was somewhere sold to BHP. Now it's a BHP Rio and Jayco joint venture. And then, you know, it was taken into production on a smaller basis, I think in the 90s. And it was not before the year 2000 with this commodity bull market when the best copper mine ever made profit. So this shows a bit, you know, what we're talking about in terms of adding production. And maybe the last slide, Alex, I really recommend to look at this internet link, which shows the story of Freeport's Grasberg mine, which is one of the biggest mines in the world, copper gold. And this story is that it was a geologist from the Netherlands. It was funded by Royal Dutch, who first went up in Irian Jaya to these glaciers. And it was said that some of his friends, which tried the same, it was a Rockefeller, was eaten by cannibals. So this was in the 20s. And then he saw there were outcrops, and, you know, with blue specks on it, on 4,000 meters above sea level, out of nowhere in Irian Jaya, which is the Indonesian part today of Papua. And then he came back and wrote a geological study about this. And this came out half a year before the Nazis overrun the Netherlands. So the world had other problems for many 20 years. And in the 50s, you know, this report came up again in the hand of an American mining company, Freeport. So making wars is always bad and losing them even worse. But it was the Americans who had this report. And then, you know, this first mine in the 70s was developed by Freeport in the bull market. And it is said that it had cost $7 billion in the 70s. So who knows what it is today? This was the first mine. It was called Erzberg. And we mine today another one next to it, on the next peak, which is called Grossberg, which, by the way, is going underground, which is obviously having a huge impact on costs and blah, blah, blah. So I really advise you to have a little view at this movie, which shows a bit, on the paper what we're talking about, but in real terms, what it means to open such mines. And we would need at least one of them every year just to keep the production up stable, not talking about some, all these things we're talking about. So we think, to conclude, I think we are heavily underestimating the real life problems of really increased supply without taking into account, all the financial things and stuff like that. So that's from my side, a few words.
Thanks a lot. Thanks a lot, Urs. We are approaching the 1 hour time, so I'm actually going to be fast. Just to conclude, we updated here the see-through profitability of the Classic, and if you look here, it's trading currently at 10.4 times earnings for 3.3% dividend yield and 1.6 price to book. On all the ratios more attractive than the global equity market, which gives us a lot of cushion to really deliver our targets that Marcus was commenting about. That is just a chart on the long term. We can skip that. I want to stress as well the fact once again of Marcus and Urs that we are just at the beginning of the cycle. Here you see mining relative to MSCI World. We see basically that we just have started there. And the same thing is true for energy. And to conclude here is actually the fact what you see is the similar for the natural resources fund, an 8 times earnings, 4.1 dividend yield, and a very attractive price to book as well. What's also interesting is that, of course, analysts are next expecting earnings to go higher. They don't expect dividends to go up. Why? Because they're actually too cautious in our view when it comes to oil price assumptions. And that basically is the reason for that. That was it. Now we still have a couple of minutes for Q&A. We already have received the first question, Marcus. It was more on the timing side. When do we expect actually the Norwegian tax issue on the salmon sorted out?
Yeah, well, we spoke to SalMar recently. They told us, and they shared this with everybody, that they expect the proposal to be out in the next few weeks. So maybe 3, 4, 5 weeks, and then an agreement before the summer. So this would be the expected timeline is let's have something material from now to the summer.
Thanks a lot, Marcus. I mean, maybe a related question was also sent to us by email, maybe for Carlos. How do we see the situation with higher taxes, with higher prices in commodities and salmon being kind of commodity here?
Yeah, well, that is going to happen. It happens in every single upcycle, and it just reinforces the cycle. Let me go back again. I mean, this sounds simplistic, but it is very important not to lose sight of it. Prices go up or down. They go up because either supply goes down or demand goes up or both. Now, if we have a problem that prices are very high because there is not enough natural gas or oil or salmon or whatever you want, and you penalize the suppliers and subsidize the buyers, you are going to have prices going through the roof. As Marcos was saying, even if you increase the taxes on salmon, well, that will reduce the production of salmon, which will increase the price of salmon, which at the end of the day does not affect the companies, it affects the consumers. It's very hard to believe that higher taxes over the long term do not hurt producers as much as consumers. But that is the way it is. Companies are just machines. I mean, we're a bunch of people. We together, we put our money and we produce something. And if we don't make money, we don't do that anymore. And that's as simple as that. So there is nobody in the world, except in a dictatorial place, where you can force us to make salmon or oil below cost. I mean, that is not going to happen. Now, you increase our taxes, we increase our prices. There is no other way around. And that's going to happen. It's always happened. It's important to underline that it has nothing to do with third world banana republics. The highest tax on oil has always been enacted by the UK Tory Conservative Party. The first time when Cameron went into power, and this time when they got into power after Johnson. So it has nothing to do with geography, and it has nothing to do with ideology. You know, they will go for the money because that's where the money is. It's the famous thing. I mean, why do you rob banks? That's where the money is. You know, so this is going to happen, and all it does is aggravate the cycle because you cap production. Nobody's investing now in the North Sea oil and gas business when we need that gas. I mean, that's the last domestic gas, natural gas that Europe can use after Russia. And now we're cutting their production because nobody is investing in it anymore, thanks to some brilliant taxes, which are not going to solve any macro problem for the Tory party. And then the same government turns around and subsidizes all the consumers and industries, because obviously otherwise they get extremely angry and vote the politicians out of office. You know, Germany has spent $700 billion on subsidies for our resources. Well, when we get to these numbers, they very quickly are meaningless. But to give you an idea, a new nuclear plant costs 25 billion. For the money that Germany has spent 1 year subsidizing energy prices because they're not producing enough, you could have built 30 nuclear plants and export electricity to the whole of Europe. I mean, the whole thing is completely stupid, but it is going to happen. So these taxes, we have to count on them. That's the way it is.
Maybe I can also add something. You know, the problem, and I call many commodities always the price of the glass of water in the desert. And if you have 100 people in the desert and 100 glasses of water, and you take one away, meaning 1% supply away, the price effect will not be 1%. The price effect will be probably a few 1,000% or everything, because, you know, the multiplier or in an inelastic demand supply curve is a multiplier. So if you take 1% supply away of something which is essential, the price effect is not 1%, but it is, you know, depending on the goods.
You saw that in November with natural gas prices futures in Europe multiplying by 10 in about 2 weeks, because an industrial plant will pay literally anything in the short term to keep going. Eventually, if the price stays there, they shut down the plant. But for the time being, you know, they will pay whatever it takes, of course.
We have another question from the audience. By the way, you can still send us additional questions if you may have, which basically asks, do we see for oil companies that they have problem in refinancing their debt? Marcos.
You know, broadly speaking, the oil companies, the MPs, have made a huge free cash flow in the past 2 years. More or less,
they have no debt.
Was unbelievable. So exactly the level,
Yeah.
as Carlos says, the level of debt now is very low across the sector. Even Harbor Energy, that used to have a problem in the balance sheet, now is free of debt. So this problem is over. Only in a scenario of very low oil prices that we don't see would hurt this a little bit. So we don't see this as an issue anymore. And just to highlight that the companies now are much more disciplined than ever. So they are not reinvesting at the pace they used to do. They have realized that they need to reach a return. They are aligned with shareholders. So now the sector is not investing more by far than they generate in cash flow.
Yeah, I would like to
Chevron, you know, a big oil company. I mean, they can't buy back debt anymore because they buy back now a quarter of the company. So it's.
I have no idea. No, I would like to add, and this is important. 3 years ago, when the COVID started, and even with the price war that the Saudis and Russians did, and the oil price going negative, and blah blah blah. Many oil companies, some of them we own, like Cenovus, which is a huge company. We're talking about the $15 billion market cap company. The share prices went down to really distressed value. And the reason is they had a lot of debt. Now, if you have a lot of debt and the oil price goes negative or very low for 1 year, you're dead. I mean, you can do all the spreadsheets you want, but you will not see the right-hand columns because you'll be dead. But now they have no debt. I mean, all companies have no debt. So the level of risk, even if we do not, of course, see oil prices going down, it's very important to stress because risk is about, covering for where you do not expect. Now, we do not expect the oil prices to go down. But even if they go down, companies have no problem. They have plenty of staying power until the things turn around. So, and this is a very important qualification. These companies are now, well, they're a bit more expensive than 2 years ago, but they're extremely more resilient and much better investments, in fact, than a couple of years ago. That is an important consideration.
We have received the last question that we take, and then we have to conclude because we are running more than 60 minutes. The question was coming in lithium. If somebody would like to buy something for the next 5 to 10 years, which is the best company? Maybe yours?
Yeah, probably, as we said, Albemarle.
But we also argue maybe there's not even enough copper for all the electrical cars that are going to be built, and then maybe lithium is an issue. Huh?
It is a bit a problem, obviously there is valuations, given the hype in lithium, the valuations are obviously much higher than in copper or in oil and stuff like that. But the thing is, if you look, let's say, at the iron ore prices, was it 2 years ago or last year? Yeah. So, the problem is China, which is the steel industry of the world, was not having enough coal and not having enough electricity. So they had to cut back, and they were rationing energy for the heavy industries. So obviously then the production was going down. So if you cannot produce enough steel, not because the demand is there, but because you have not other ingredients, then obviously also the demand for iron ore goes down, which led to a correction of iron ore. So, this whole story about lithium is a bit, you can have your opinion about these Tesla stories and so on. We have ours, but the problem is if there are other things not there, that the whole demand can be there. And this is going from the infrastructure to the cobalt, the copper and the charging and many thousand things. Then, you might be a problem that there is lithium, but, you cannot absorb it in the way you wanted to, which is, by the way, already a problem, I think, for Teslas or so, that the refining capacity, for example, or the processing capacity is not there. Similar, like in the uranium industries, 40% of conversion enrichment is in Russian hands. So this is now a big problem that you have, the whole infrastructure not there. So maybe, the uranium demand cannot be so good. Because first of all, you don't have more plants, but also, the whole refining, as Carlos said, is not there. So we are at the moment a bit cautious on that sector.
I think we have to conclude here, my friends. And thanks a lot for the audience to be there for so long. And once again, sorry for the hiccup at the beginning. We still try to improve and we still try to learn. Hey, thanks a lot. Have a great weekend when it's time then to all of you. And we would very be happy to do follow-up meetings with you in person. Thanks a lot and take care and have a good time. Bye-bye.
Bye. Thank you.
Bye, Alex.
Thank you. Bye-bye.
Bye-bye.